He's my boss, actually. I work with the company. He's the founder of NBI Financial Group. We're a broker company. So now I switched companies, James. I'm able to better serve y'all.
Fantastic. Fantastic.
All
Looking
right.
forward to a deal.
Thank you, James.
You too. I'm going to change rooms.
James is the man. I want to tell you right now.
Change rooms.
James has been on this podcast. Evelyn's been on this podcast, helped create this and get our content out, and have a lot to contribute. And then we usually have a guest speaker. So here we go. We're live, ladies and gentlemen. Welcome back to the show. This is Real Estate Unlimited, and we have a special guest, Nick Campo, who is the founder of the NBI Financial Group, Evelyn Olivares, and James Frankline. And we are here. Thank you, guys. Today's topic is first-time home buyers. So I'm going to quick do the countdown, and we're going to get back into this and just start talking. And I'm looking for the countdown. And welcome back, everybody. Thank you for joining us. So today's topic is first-time home buyers and what is a first-time home buyer. And I've got music going on in the background that needs to be stopped. There we go. So what is a first-time home buyer? First-time home buyer is someone who has not owned a home in the past 3 years for North Carolina. Now, my question to our lenders here on our left, which will also be our right, is if you owned investment properties but you were renting, but you own investment properties in your name, do you qualify for first-time home buyer benefits?
You do not.
Got you. Because you have a property in your name.
And that correct. And that also, it's not just a North Carolina thing. That's a federal guideline, right? So that's the entire country, right? So if you have not had any type of mortgage note in your name in the last 3 years, it can't. Second home, investment property, primary residence, as long as you haven't owned any of those in the past 3 years, you will qualify for the benefits of a first-time home buyer, which are typically less of a down payment. So on conventional, you can go down to 3%. You qualify for down payment assistance programs in a lot of instances, unless you work with somebody like NBI, who's us, and as long as it's primary residence, we can get you down payment assistance and things of that nature. So, but 3 years, you can't have any type of mortgage for 3 years. So,
great. And those of you tuning in, this is Nick Campo. He's the founder of the NBI Financial Group. Evelyn also works for them as well. So, as a broker, you're a broker now. Is that right, Evelyn?
Yes, we're a broker company.
Awesome.
Yeah, we're a mortgage broker.
Mortgage brokers, yeah.
Okay, awesome. And a little bit of information on some benefits being a first-time home buyer that you guys have to offer.
Well, what we have to offer is we have every single down payment assistance program that you can possibly imagine, right? If you're in a state such as North Carolina that has state programs, county programs, we offer all of that. The other advantage to working with us as a first-time home buyer is we are partnered with 15 different lenders. So, for example, United Wholesale, Freedom Mortgage, those are just a couple to name them. Flagstar Bank, which is one of the biggest mortgage holders in the entire world. We're partnered with the biggest, so they're competing for our business, right? And part of competing for our business is they have to give us products and pricing that will benefit the consumer, which is why mortgage brokers have gone from 8% to 33%. So if you're a first-time home buyer or any buyer in general, you're getting better pricing by working with us as a mortgage broker. But as a first-time home buyer, they have to put in programs to incentivize us to bring in business. So we actually have bank DPA programs. DPA stands for down payment assistance. Those down payment assistance programs are better than anything the government can offer, better than anything states or counties can offer, because they're true day one equity programs, meaning you qualify based off FHA qualifications. The bank will give you, the bank or the lender will give you 3.5% towards your down payment there will not be a second lien or a minimum amount of time you need to stay in your property. So what that means for the buyer is, hey, after 210 days, because typically on the DPA program across whether it's retail mortgage lenders, banks, credit unions, mortgage brokers, you're considered more of a risk because you're not putting, they're considering you not putting any of your money down. If the more money you put down, the less of a risk it's considered. While on down payment assistance, because you're putting less money down out of your own pocket, you are typically 0% down, you're considered more of a risk, so the interest rates are higher. Well, with a true day one equity program like mortgage brokers can offer, you can refinance that on what they call an FHA streamline after 210 days. So 210 days, which is 7 months, and 6 on-time payments, you can do an FHA streamline refinance, which allows you to net escrows and skip a monthly payment and get into that lower rate, right? So you'll end up getting into the lower rate and you truly have day one equity. Whereas banks, credit unions, retail mortgage lenders, they're typically telling you about the down payment assistance programs. They don't have those programs, right? So they're going to tell you about a down payment assistance program, and they're typically county, and they'll say, okay, well, we're putting a second lien on your property, which means your mortgage is lien 1, that DPA program's lien 2, and on top of that, they're requiring you to stay in that mortgage anywhere from 7 to 30 years. So it's very hard to refinance in that situation, which means you're paying, so I'll give you an example. I just had a client who had a 7.5% interest rate on a down payment assistance program. After 200,
you're back.
Can you hear me?
Yeah.
Okay. So we had a client who did the down payment assistance program. That's a bank program at 7%, 7.5% interest. It was a $300,000 mortgage. 210 days later, so you skip your first payment after you close on a mortgage. They made 6 on-time payments, so that's 7 months, 210 days later. We did an FHA streamline with the same company that has that bank program. We were able to net escrows, so there was no closing costs there. All they had to do was pay less than 1 month's payment. They had to pay the interest portion of a monthly payment at closing. They skipped the next month. They went from a 7.5% to a 5.85%, saved themselves $400 a month. Now, if you're going to a retail bank, retail mortgage lender, credit union, they put that second lien on the property on those down payment assistance. So you're going to be stuck in that 7.5% interest rate for anywhere from 7 to 30 years. I've seen some of them. So when you come to us, we're going to look and give you multiple different options. But a lot of times I want you in the bank day one equity program, because if not, that higher interest rate is causing you to pay more in monthly payment over a 7-year period than the DPA, the down payment assistance, was even worth. So down payment assistance is one of those things where it sounds great on paper, but you need to make sure you're in the right program, which a mortgage broker is going to guarantee that you're in the right program, because we have a litany of lenders that we work with compared to going to credit unions, banks, retail mortgage lenders. They just have their suite of products, and typically their down payment assistance programs are the government-backed programs, and the government's going to make their money somehow, and they're making it through those higher interest rates.
Okay. So let me ask you, Nick.
That's a lot. I know. Sorry.
That was.
I'm extremely high level. I've been doing this for 13 years. I've been running my own business. We started with an underwriting background. So I have a lot of knowledge. I also work with, we have our own podcast. We had 61,000 views on our last video, our last podcast. So we have a lot of information that I can give you. So you're going to, for the audience, ask me as many questions as you think that your buyers would be asking in a situation like this.
Real quick, what's the name of your podcast, Nick?
The Loan Guys, but it's on our NBI Financial Group LLC. It's on YouTube. We're on TikTok. We're on LinkedIn. Instagram. Just go to NBI Financial Group LLC on all the social media platforms, Facebook, all of it, and you'll be able to see it
Awesome.
and find it. So
Cool.
TikTok's where we get all of our views. That's where we got 61,000 for our last episode. So
okay. Cool.
Some people love me. Some people hate me. When you get that big, you can't please everyone.
Yeah, that's how you know you're doing something right.
Right.
So
if you,
yeah.
Yeah.
Uh,
So
so
also I wanted to mention what Nick was saying. One of the things that I joined, one of the reasons that I actually love their platform as a mortgage broker is because usually banks would tell, or a lender would advise, or a realtor would advise their borrower or the client, oh, shop around for the best rate. So they don't have to do that. We do that for them. Okay. We save them time. So we're actually going to do that for them, so
And
they don't
money.
have to do it. So we're going to find you the best rate with the best closing costs, lower closing costs possible. So that's what we specialize in. So I think that's an awesome part of this being a mortgage broker as well. So
okay, if I have a client and they're going North Carolina down payment assistance and they're
Yep.
getting the 15,000, which is
Mhm.
another lien on the property.
Correct.
After 8 months, are they able to refinance to a lower rate?
That's the $1 million question, right? So that's typically going to be qualified, and I would have to actually look at that specific program because there's multiple.
We lost Nick there. Yeah.
Yeah, he should be back shortly. He's driving. He's going to a realtor meeting right now, but
Gotcha.
Right. So would they be able?
Yeah.
Typically, they're going to qualify an FHA for that program. So if it's the program that I am thinking of, the short answer to your question is no. The long answer is yes. So the short answer is no, because if you're having to qualify with down payment assistance, typically you don't have the funds or don't want to use the funds that you do have to put the down payment on the property. The only way you're going to be able to refinance is if you pay off that second lien, right? And the reason I say that is because on FHA is very, very tricky when it comes to refinancing with a second lien. You can sometimes do it on a rate and term, but you're definitely not able to do it on a streamline. On a streamline, it's very tricky to do that. You would almost have to go conventional and then pay off that down payment assistance. So after 8 months, are you going to have the $15,000 to pay off that down payment assistance? Is your home going to have the extra $15,000 in equity in it to pay off that through the refinance? The answer to that most of the time is going to be no. And then also, was it really down payment assistance if you're having to pay it off the refinance?
Right.
I saw the smile. That's $1 million question, right?
Right.
Like,
Okay.
so that's the issue I have a lot of times with down payment assistance, the way they're advertised and marketed. I have a huge issue with that because we're not giving the client the actual information. I have a huge issue also with a lot of these community programs because it's the same thing, right? You saw Bank of America who comes out and they market to the minority communities, and Wells Fargo follows suit. But what they failed to tell you is they got rid of a lot of their they got rid of their correspondent lending divisions and things of that nature. What helps, and a lot of that helps the local communities, and a lot of the people in the local communities, like the minority community that they're marketing to, use FHA to get into homes. FHA is designed for a lower income borrower, which there's a bunch of them across all communities, right?
Mhm.
But when they pulled those programs and started advertising this new down payment assistance stuff, and
he's frozen there, but
Yeah. Hopefully he comes back.
I call it a spin zone because it actually hurt minority communities more than they are willing to tell you, because they were doing trillions of dollars combined in business and FHA in those communities, and they slashed their lending program or their correspondent lending, get rid of it completely because it was losing money, and then say, oh, well, if you bank with us, we still have X, Y, and Z program. But those X, Y, and Z programs are geared with second liens, keeping people in higher interest rates for longer. If you're really trying to build wealth through those communities, in those communities, in low-income communities, first-time home buying communities, whatever it is, new household formations, you need to have them talk to somebody who actually knows what they're doing as far as, and typically I find it's mortgage brokers who can go to those communities, explain to them, hey, listen, if you do this program, that's great. It gets you into a home. It's better to be in a home and be an owner than not to be in the home, right, and to be renting. So if you have to do that, but there are other options out there. There are day one equity programs. So, you can look at what is going on and the way these down payment assistance programs are marketed. And it almost, to me, feels like you're targeting people who might not have the education that myself has or Evelyn has or you guys have being in the industry every day. And you're putting them into a situation that is all sunshine and rainbows until there's a life event that occurs. Until there's a kid that gets married and they need to take some equity from that property, then they find out, oh we're still inside that X amount of year mark, man, you know what I'm saying? Like, so,
Yeah.
or maybe there's a medical issue and now you're stuck. Like, what do? You don't actually have the equity in that home. That equity in the home has to go back to pay the government, or that equity at home goes back to pay Bank of America or Wells Fargo. So you really want to be careful with a down payment assistance program and talk to somebody who's going to educate you and give you options, that's what I stress here at NBI Financial Group. The reason we started our podcast is to beat back against some of these bad marketing techniques, beat back against some of the stuff that the media is saying about what the housing market's going to do. It's not crashing, folks. Month over month is actually up in a good way, right? So it's to beat back against all of that and to bring education to the communities like where I grew up, Amsterdam, New York, the biggest welfare county per capita in the entire country. I want to educate people from places like my hometown, right? Because the fastest way to build wealth in America is through real estate. And that's not a quick rich scheme. That's just what it is. That's the truth. If you look at the average person who has at least a primary residence, 75% of them are going to be way more well off than if you don't have a primary residence and you rented your whole life. So with the down payment assistance programs, to go back to that, to the first time home buyers, you need to talk to somebody who actually has an education, who does this on a day-to-day basis, who understands what these businesses are trying to do. And Wells Fargo and Bank of America, folks, they're not your friend. The credit unions, they're not your friend. Like, they just aren't, and they're not looking out for you. And the people there, they aren't bad people. They're not trying to necessarily take advantage of people. They just don't know.
Yep.
They don't know. And it's a sad thing. And like, you know, and Evelyn's new here. Evelyn's going to be able to say all of this like the back of her hand. And she actually found us through our podcast, which we appreciated. And she reached out, and I'm happy to have her. She started with us, and she's already brought in a bunch of business, and we've been able to help people. But the biggest thing that gets on my nerves is a lot of lenders get a bad name, or the mortgage industry gets a bad name, because you have some bad characters. You have some people who are executives and their job is to drive profit for these big companies. And then you have, a lot of people and a lot of mortgage brokers, which is why we keep eating up market share, who are actually trying to help. And so we're here, we're fighting back. I actually left a very good job at one of the third largest lender in the entire country as one of their top salespeople to start my business. And I know we're doing something right, because we have people who are quote unquote punching down because we're not as big as them. And I'm getting some messages and some stuff saying, hey man, what are you doing here? But 99% of the people, the working class, the people who make this country run, the people who deserve to own a home, not the Black Rocks who are buying up section after section of single family housing, we're going to benefit those, and we are going to fight on behalf of the person who's a first time home buyer. We're going to fight on behalf of the person who's trying to go from that 2-bedroom to that 3 or 4 bedroom because their family's growing. We're going to fight on behalf of true Americans every single day, because the American dream is still alive. We just need more people like ourselves to stand up and fight for it and help to educate people on how to achieve it.
Absolutely. If it ain't worth fighting for, it's not worth having.
100%.
Lovely. Are you in North Carolina, Nick?
Both North and South Carolina. So we're based out of Rock Hill, South Carolina, which is right on the border of Charlotte. So I call ourselves the premier mortgage lender in the Carolinas, premier mortgage broker of the Carolinas. Can't leave these Carolina blue skies. We're working on Texas, Georgia, Florida, Virginia next. So we'll be in 5 states. We'll be in 50 states, hopefully within the next 10 years. We have an all-star team here. We really do. The operations staff that's helping me build, my business partner, top 1% of underwriters in all of America. He has his DE lab, chums. We hired who I call now a business partner, Sarah Crespo, who's building out all of our processes for our same thing. The people that we're hiring are people who came up with us in the industry and people we've vetted for the last 13 years to know, like, hey, listen, like, we're coming and we're carrying that big stick, if you know what I mean.
Mm-hmm. Mm-hmm.
So
absolutely. I think it's very important to educate the client, and that's how you're. I feel that it's the best ammunition you've got here,
that's
because
my passion.
You're helping the people, and it's not a sale. And in as a realtor, there's a buyer agency agreement,
right?
But maybe that's why the lendings may not always have the best rep, but you're literally doing a buyer agency agreement. You're actually looking out for the buyer in this situation.
I believe my fiduciary responsibility is to the buyer all the time, right? So let me give you a couple of things, right? So I'm very passionate about education and financial literacy. Home ownership is part of that financial literacy and education, right? 3 out of 5 Americans don't have a budget. Well, and then I hear about how hard it's to buy a house now and it's unaffordable. Well, if you don't know what your money's doing, of course it's hard to buy a house, right? So step one is like, let's get some goals. Let's get on the budget, which your budget is your game plan to get there. Let's look at, hey, why don't I have a 20% down payment or a 10% down payment or 5% down payment? Let's look at that. That's financial literacy. Are there other ways to get into a home? Yes, there are. I personally believe it's never been easier to buy a home in America with all the down payment assistance programs, the 3.5% FHA. You can go down to a 500 FICO now and be able to purchase a home if you meet other, manual underwriting guidelines, right? So that's one, and I'm very, very, very passionate on financial literacy and educating the consumer. And then the other piece is protecting fiduciary responsibility to the buyer. You're not a transaction to us. You're a client for life. So one of the things we also do here is, we preach primary residence number one, and then we'll show people how to build wealth through real estate as well. So we came up with something that nobody else that I know of is doing. It's called a comprehensive real estate plan. So after we get you into a primary residence, what is it we can do to build wealth through real estate? Well, if you follow the plan, you will be able to purchase one investment property, rental property per year for the next 6 years. So that'll be 7 years. You'll own 7 properties. We'll show you how to pay off the 6 investment properties within 14 years. It's as simple as an amortization schedule. And we show you that, and we touch base with you on a quarterly basis, almost like you have financial advisor. We're your mortgage advisor, and we will show. And where's that that not only benefits the buyer, but the realtor, right? So every single one of those homes now goes back to the realtor. The other thing we do is we ask each person we work with, we ask them, hey, can we get 3 leads? We get those 3 leads from them, whether it's mom and dad, friend, relative, somebody they know. Maybe it's somebody who lives in the same apartment complex. We get 3 leads from them. Hey, who else can we help? Well, we've provided the white glove service. You need to talk to Paul. You need to talk to George. You need to talk to James. You need to talk to Evelyn. And guess what? In our CRM, your name's now tied to that lead that comes in too as the realtor. So we're driving business back to you, because if you're working with us, we're probably working towards the same goal. You have a podcast, so you want to get the education out there, and you want to get the education out there for the first-time home buyer. They just got a lot of stuff on down payment assistance, a lot, and they probably won't. Go back and watch it 2 or 3 times. Write your questions down. You can go to my personal Instagram page, Mortgage Man Nick, and send me a message. Go to my Facebook, my LinkedIn. I'm Nicholas Campo on both of those. Send me a message. Look me up on NBI Financial Group.com. Send me an email, send me a text message. My phone number is out there. My phone number is associated with it. Ask me questions on that DPA stuff, because it was a lot. But yeah, our whole goal is to help people build wealth through real estate. And not everybody wants investment properties. Only 30% of our clients want investment properties. But to build wealth and to leave something to your family, to have a lasting legacy, you need to get into a primary residence. If you are renting, you're burning money. So I'm going to use Mecklenburg County as an example. Or let me use York County. I know these numbers just a little bit better. So York and Mecklenburg are right next to each other. They touch. One's North Carolina, and the other one's South Carolina. So I'm in York. Like, I personally do a lot of business in York County. In York County, if you were to rent a single family residence, say married, kids, whatever, renting a single family residence, on average, you're going to pay $1,800 for that single family residence that you're renting per month.
Okay.
If you were to buy today, and say your realtor can't negotiate any seller credits, say that we aren't able to buy the interest rate down at all, we're just going to buy average down payment, you are going to pay about $1,900, so $100 more per month for the purchase. In 3 years, according to CoreLogic, and CoreLogic data is the biggest data company in the United States. That's who MSNBC, CNN, Fox News, all of them use when they're talking about data, and they actually take the data and they skew it to whatever their opinion is. I'm going to give you the actual data. 5% on average per year is the increase in rent prices. 3 years from now, you'll be paying almost $2,200 for a single family rental. 3 years from now, if you were to purchase a home and never refinance, you would be paying $1,900. Here's the other stat, and this is just your county, and every county in the Carolinas, it's a little bit different, but it's all saying the same thing to me. If you're to purchase a home in York County, within the next 3 years, you will have gained on average, based off of CoreLogic data, on average $140,000 in equity, and that's because you're paying down the principal with those mortgage payments and the amount of appreciation that we are having here in the Carolinas. I think that's a 7% appreciation rate. So if you were to sell in 3 years after realtor fees and closing, seller closing costs, things of that nature, you would probably pocket over $100,000 in profit by buying today and selling in 3 years, compared to if you were to rent and not get anything. That's actual CoreLogic data. So the data tells me that if you don't like money, rent. If you don't like building wealth, rent. Now, there's some situations where maybe you're moving in 6 months, maybe you're in the military. There's some situations where it makes sense to rent until you're ready, because there's more than just the financial side of it.
Right.
But
yeah, some people need to rent, but
Right.
As far as building wealth, and again, wealth is built through the real estate.
100%.
I was talking about this earlier today with a friend before I came here. There's no such thing as fast, easy money. You're going to have to work with it,
Right.
unless you're selling drugs, and still you got your life to worry about and paying off people.
Well, that's
But-
not easy either. Have you ever been shot? Have you ever gone to prison?
No. So there you go. That's what we're saying. Yeah. Is it's not
I've
easier
got
because you're
friends
getting death threats?
Listen, I've gotten friends who've gotten shot. I've had friends who've gone to prison. It's just the product of the environment I grew up with. Doesn't mean they're bad people, but I bet you if you asked them now if they wish they could go back and buy a home and make their money instead of selling the drugs and doing that type of thing. I'm talking some of the best athletes you'll ever meet in your life that never played college sports or anything like that because they were in prison. Like
That's right.
my best friends, like really good friends with some of them. So
Yeah.
I got a question. With this game plan that you touched upon as far as investment properties,
yes, sir.
investment property upon investment property, would that be involved with establishing a trust and an LLC to hold those?
I always advise. That's what I always advise. Now, if you're taking a mortgage on them, a lot of mortgage companies are going to make you closing your current in your name. I would advise to deed it into an LLC after the fact. And I always say, for those who want to really grow, I would only hold $10 million worth of properties in a single LLC, and then I would start changing it up because it limits the liability. Everybody, one of the things that I have found out as I've gone throughout my career is at some point, if you're being successful, people want to sometimes come for that success or don't think you deserve it, or maybe you have a tenant that slips and falls on an icy sidewalk that they're required to put salt on or to shovel off, and they don't, and then they try to sue you and sue your insurance. So I always suggest get into an LLC. Make sure you deed into an LLC post closing. Then number two, I would say definitely get a balloon policy on your insurance just in case. Now, I've been in investment property since I was 24, so 10 years, and I've never been sued with investment properties. I have had those protections in place, though, because it's what was advised. You hear all the horror stories of what it is to be a landlord, but they forget the other stories to tell you the other stories. Because what is it? Fear leads. If it bleeds, it leads. What's that saying? Right. Yeah. So there's the story of the single mom who had to move into my property because her husband decided to cheat on her and blow their entire life savings. And she was struggling, couldn't afford a deposit, told me the story. I did some background on the story. It turned out to be a true story. She ended up renting from me for 3 years, and I sold her that property because she didn't want to leave. I didn't want to sell the property, but it was there's certain things you, from a humanity standpoint, you can do, right?
Comes from the heart.
Right. Yeah. Or they don't talk about the person that I had that was in my property when he was a carpenter, and he had moved down to the Carolinas and was looking for a place to live, and he noticed one of the doors wasn't working correctly, and because that's what he did for a living, he got an extra door from one of the builds he was doing and just put it on the house at no cost, painted it, looked awesome. I didn't even know about it until years after the fact when he told me, right? Because at the end of the day, we're all human. We're all people. We have to live in this society together. The only way to get this world a better place is to lift our communities up. So there's a lot of nobility in it too, because people need a place to live, and we don't have enough homes in America. There's 1.9 million new household formations, meaning new homes needed for new families, new formations of households. Only 1.4 million projected completions. There's a $500,000 home shortage, and a lot of that's being seen in the Southeast because of everybody moving here.
Right.
Yeah.
So, it's a noble thing to be a good landlord.
Absolutely.
And a good realtor.
Yes, it is.
So
Absolutely. And you can say it better. We are in a home shortage.
So let me ask you something. And this is really kind of a hot topic and a topic of controversy now with Biden. And I think I know where I'm going with this. With Biden charging like a higher rate with higher credit scores. So
yes,
that money is being used to subsidize persons with lower credit scores so that they can get lower interest rates. So can you talk about that?
Yeah, that was our last topic on the podcast.
Okay.
So, and I did add a question after that, because this is not an executive order, right? He just partnered up with Fannie Mae and Fannie Mac. They're the only two lenders doing this.
Have you guys watched Joe Biden speak lately?
I tried.
Yeah.
I don't think he's doing anything, to be completely fair to poor Joe. And now I'm not a political person. I will tell you I'm libertarian and I don't like government. But I also recognize the need for like taxes and police forces and fire departments and things of that nature, right? So I always preference everything I'm going to say when it has anything to do with policy is I don't care if it's Donald Trump, George Bush, Barack Obama, Joe Biden. If it's not something that's a good policy, I will criticize it. And if it is something that's a good policy, I will commend them for, right? So essentially, if you put more of a down payment, if you put more of a down payment and your credit score is higher, you are now getting what they call an LLPA hit, or where the LLPA is not as good. They lowered the LLPA. What the LLPA is called the loan level pricing adjustment. And so there's your interest rate that comes out, and then there's your par interest rate. And when you're seeing what a par interest rate is, that's including a lot of the loan level pricing adjustments. What a par interest rate is a par interest rate means there's no cost and there's no credit for that interest rate. So let's just, for a quick example to preference this before we get all the way into it. So if par rate today, and this isn't what it is, but if a par rate was 5%, we're going to use that to make it easy. At 5.5%, you would receive a credit. At 4.5%, you would get what they call a discount, which means you're paying for that 4.5% interest rate. And some people do it because over the life of the loan, it could be a good investment to them, right? So your par rate is after the loan level pricing adjustments. So, and the par rate is different for each individual because if you have a great credit score, you used to get a loan level pricing adjustment for the positive. If you put more of a down payment, you used to get a loan level pricing adjustment for the positive. What's happening now is if your credit score is worse, and if the down payment is less, they are now hitting you less in a negative way on loan level and pricing adjustments. And if your credit score is higher and you're using more of a down payment, they're now giving you less of a positive loan level pricing adjustment, which is now going to incentivize people to put less money down and not to worry about their credit score as much, right? So why are they doing that? I'm going to play devil's advocate a little bit.
Okay, please do.
So and I will say I do not agree with what they're doing. Let me preference that. So, because I have a lot of people who came after me after the last episode, because my business partner Ben is not. I'm a very passionate person. Being an Italian American, we're passionate people. Ben is Scottish, and the Scottish have no personality. So no offense to the Scots. I love y'all. You invented golf. I live on a golf course. It's great. So, but long story short, he got fired up on the podcast, and we do a live. We stream it every Thursday from 12 to 1. And man, his little ass was going crazy about this. And I looked at him. I was like, we have like a switchboard and stuff that we switch back and forth, and we do it in studio. And you guys will have to come down to Rock Hill and join it. You guys seem great so far, and I would love to have you on ours as well. But I looked at Donovan, and Donovan looks at me, and we weren't used to that much excitement. So I said, let me play devil's advocate for a second. We have a housing shortage. We're trying to push first-time home buyers.
Exactly.
How do you incentivize a first-time home buyer? You don't hit them as much for their credit score. You don't hit them as much for less of a down payment. How do you take somebody who's very financially literate, who understands interest rates and understands investing and understands saving money and understands keeping their credit score high and understands the cost of actually borrowing money, and convince them not to buy, so maybe you free up some more inventory for the first-time home buyer? You don't give them as much incentive to leave the house that they're already in at that low interest rate. So you take away some of the incentive that you were giving them. Now, here's the flip side to that. A lot of first-time home buyers are going to pay their bills. A lot of first-time home buyers are going to pay their mortgage. If we're doing this on a mass government scale and it's being pumped out across, and this is what you're not seeing the objectivity on the news. All they're talking about is how bad it is. But I have to agree with some of what they're saying is, are you incentivizing people who maybe aren't financially literate or financially responsible or understand the ramifications enough?
Yeah.
Are you incentivizing them not to buy homes? And then we'll see in 360 months, 3 years from now, how this works out. We're not going to know today, tomorrow, the next day. We're going to know 3, 5, 7 years down the line. And let's look at the foreclosure rate at that point, because I'll tell you what, I learned things the hard way. And I was 22 years old. I bought my first house. I bought an investment property. I was working in the mortgage industry, but I wasn't financially literate. I kind of told you guys the background of where I came from, and it was always a hustle, and it was always trying to get one over. So I decided to open up a bunch of credit cards to buy all the furniture for the house and also put a TV on the wall. Man, I got the biggest, baddest TV. I'm a huge Dallas Cowboys fan, had to watch the games. Got this baddest TV. Yeah, no, it's okay. I hold it against myself. Anyways, long story short, what I'm getting at is I decided not to pay those credit cards. And my credit score dropped really low. So by the time I was 24, I had
he'll come back.
Yeah.
I had a terrible credit score. I wasn't able to buy any more investment properties. It got to the point where in the mortgage industry, they run a background check on you yearly. And they're like, why is your credit score so low? I was like, oh, this is free money. And it was just stupid, financially illiterate stuff, right? Now I fixed that, and I'm over 700 now, but I had to learn the hard way. I am hoping that the government is not incentive, and I'll say it's technically not the government, but it's pressure from the government. I'm hoping they're not incentivizing young, dumb people like myself to go and do something like that, and then you crash our economy.
Right. Right.
And I'm not afraid to talk about what I've done, because we all make mistakes in our past.
Oh yeah.
And that's part of it. But I had to learn that the hard way. And, I think that I think they're incentivizing people who are financially literate, who have high credit scores, who are probably already homeowners, not to buy. And I think it's part of the inventory crunch.
Yeah. And
I think in theory, it's a good idea. But what works in theory doesn't always work in practice.
So true.
Right.
So, yeah.
So do you suspect it's going to backfire?
I will say this.
Is it just too early to tell right now?
So FHA loans typically. So you guys, do you remember what subprime is?
Oh yeah, I remember. And see, that was in the back of my head the whole time you were delivering your answer. Are we going to go through this all over again?
Explain a little bit about subprime because I'm not familiar.
So subprime was basically bad. Like they were less qualified buyers back pre 2008. They had a
Okay.
lot of like stated income things of
You
that
had a
nature.
post to get a loan.
Yeah.
Yeah.
Yep. 100%.
I remember
So
that. Yes.
subprime is what caused the 2008 collapse. There's a great movie, The Big Short, that's based off of reality.
I'll watch it. I'll watch it a lot.
Okay.
It's one of my favorite movies. But
Yes.
The Big Short is a great movie to watch. So FHA essentially became the new subprime post 2008. But what they did was they backed it up with what you call mortgage insurance. And the reason you have to pay the mortgage insurance on the FHA loan for the life of the loan is in case another 2008 happens or another where a lot of people stop paying their mortgage. They're paying the banks. It's a way to pay the people who are writing the mortgage and serving the mortgage that to how to bail them out so that the government isn't having to step in and pick winners and losers, which they're doing now with these bank runs. But that's a whole nother topic. Janet Yellen, she's all over everything these days. But yeah, so long story short, do I think it's going to backfire? The other piece I forgot to mention when incentivizing people, they decided to lower the MI rate, the mortgage insurance rate on FHA. So not only are you incentivizing people with lower credit scores, less money down to go buy these mortgages, you're also making the cost of insurance less. So now I'm wondering, okay, so what happens with that MI that's paid monthly? It goes into, say, a big escrow account. And when bad things happen, there needs to be enough money there to bail out the bad things. So if they lower the MI rate, which they've said for a while they were supposed to do, how do we know there's going to be enough there if something bad happens?
Boom. Boom.
That's my question.
Boom.
So do I think it's going to work out? I will say this. It seems that whatever the government touches turns out terrible.
Yeah.
So we decided not to let the free markets work in 2008. And how's that working out for us? There's more consolidation on the top when it comes to banks. So if you look at all these local lenders or not lenders, but local banks and smaller banks, most of them are owned by the JP Morgan Chases, Bank of America's, Wells Fargo's, Chase, all those big ones. We're doing the same thing now. We didn't allow them to fail, and we're not allowing competition into the market. So it's the same thing in mortgage. It takes a lot in mortgage to start a mortgage company. Yeah. I mean, Evelyn saw it this week. Just to get her license transferred took 4 days, 5 days, and that was just literally touching a button on the computer. To start a mortgage company, if I showed you guys the amount of reports and the amount of government reporting and all the stuff that went into staying compliant within mortgage, if I showed you all that, you'd be like, holy crap, why are you doing this? Well, I'm doing it because 1, I'm an entrepreneur. 2, the only way to fight back is to get through the regulation. So what's happened now, and this is why I mentioned Janet Yellen earlier, is so America, everybody's yelling about America's becoming socialist. America's becoming socialist. And I disagree with that. America's becoming corporatism.
Yeah.
Because what's happening is we aren't following the rules of capitalism anymore. And capitalism is a great system if you like to work or are willing to work hard. You can't hold it against people who made a bunch of money. But what I can hold against them is that these big time corporations are going in and they're paying lobbyists to go up to Washington and to lobby the politicians. And then the politicians are putting pressure on the Fed, and they're putting pressure on this person, and they're putting pressure on that person. So when 2008 happened, they pick and chose winners, right? Now we're fast forward, 2008, 15 years, and we're having bank runs because people don't trust the banks, and our government decided to use the US dollar as a weapon in the Russian-Ukraine war, and that's a whole nother topic. The fact that and then there's a bank run, and then 19 countries applied to be.
Yeah.
We got to pause there.
Yeah, you got to pause. I've got so many thoughts, and it's kind of this thing. It's like mushroomed into a lot of other extraneous topics. But go ahead and continue, Nick, with that, because I had some questions about BRICS and about Fed Now as
Ask
well.
me as many questions. This is one of my favorite things to do, is to discuss like what I know. And if people disagree, feel free to push back.
Well, I wanted you to continue with your discussion about this us leaning in the direction into becoming more corporate.
So what's happening is the government is now being controlled by these big lobbyists, and these lobbyists are coming from big corporations. So you'll see, like, there's a lot of back and forth right now. I call it in politics. And it's like, oh, this person donates here, this person donates here, this person does that. Well, at the end of the day, they're all donating to everybody, right?
Yeah.
And what they're doing is they're buying the politician.
Oh, yeah.
And I think Americans recognize that. And I think that's part of why Trump won in 2016. I'm not saying he was a great option, but he was not a politician, and he wasn't going to be controlled. And now, did he handle himself correctly? That's a different discussion. But Americans recognize that, but we have no way out. So what's happening is they'll go and they'll pass laws based off of what these big corporations like the Bank of America's, JP Morgan Chase, big mortgage companies, they'll pass laws, and the laws that they're passing, they call regulation. But what they don't explain to the American people is the more regulation you have, the less competition there is, and the worse it is for you as the consumer.
Because it undermines capitalism itself, which is designed to not incentivize, but it's designed to provide alternatives for the consumer so that you can foster competition, so that you can foster innovation, so that you can foster improvement.
And this can go all the way back to like,
do that if you got the lack of those things.
Yes, 100%. And this goes all the way back to when we decided to say, okay, we're going to change China, and we're going to incentivize our businesses to go over to China and essentially use slave labor to have because it's going to be, and they sold it as it's better for the American people because it's less cost. But is it? Because now when I I wanted to have a car company, and I wanted to start a car company, I have this innovative idea, and I say, okay, well, this is going to beat Ford. This is going to beat General Motors. This will beat whoever, Chevy. It's going to cost me so much more because I'm a small business trying to come up, where they got incentivized to go to China because capitalism is going to save the world. But then they didn't realize they were dealing with a communist party who uses parts of capitalism against us, like when COVID happens and they shut down our supply chains. So what it's doing is these regulations and these incentives that these big corporations are pushing to get our politicians to pass, and then they sell it to us. And they usually put a really cute name on it, like the Patriot Act was a really cute name to protect us.
I got offended with that, but go ahead.
Yeah, but like that's just an example of the cute name they put on these bills to make, or the All-American Act.
Oh yeah.
But the All-American Act was shipping everybody over, and I don't know if that's the actual name of it, but it's shipping everyone to China. So now there's less jobs here for us, right?
Yeah.
So anyways, long story short.
How American is that? Yeah.
Yeah, how American is that? It's not. And so long story short, these companies are passing and getting these politicians to push these bills through donations to allow them to run. And I don't see a way to fix it other than to fight back by creating business. But you have to be willing to go through the regulation. Yeah. Like it's even to the point of where my business is based in Rock Hill, but we do we do some business in Rock Hill as far as mortgage is concerned, but they want to tax us on the gross amount of our total revenue. Like that is a regulation that was probably put in by other businesses here in Rock Hill that were already established. And now they want to tax a mortgage company who's going to be nationwide, a certain percentage of my gross. I said, no taxation with or without representation. I'm sorry, we're not doing that. I'll up and move my business. I don't give a damn. I'll move down the road to Clover because they won't tax me like that. So you have to be willing to fight back. And the biggest way I think is fight back. If you are an innovator, if you are someone who's an entrepreneur, you got to figure out how to play the game, because that's what it is. Don't sit here and complain about the millionaires, the billionaires, and that. Figure out it's a game. It's like Monopoly. How do I play the game to the best of my ability?
Exactly.
And I play it through mortgage and real estate. And also the tax loopholes, those aren't tax loopholes for everybody who is wondering. The tax loopholes are tax incentives. It's the government incentivizing certain behavior. So the government wants more businesses to create more job opportunities. So they allow the tax incentives to be, so for example, all of the salaries that I have to pay, or all the money that I pay, and that's a write-off for me, right? So and the same thing going in a home. The great part about being a first-time home buyer, and if you want to build wealth through real estate, is there's a lot of write-offs there, and the government is incentivizing that. So take advantage of it.
Yeah,
Absolutely.
So
That's great.
Yeah, I was just, when you talk about the automobile industry, I was thinking about Preston Tucker.
Yes.
And he had so many innovations with the Tucker torpedo. Remember that car? He had waterproof glass, I think, or glass that would craze instead of cut, become shards if you were in an accident. He had a center headlight that followed the steering wheel. That 3 headlights on the car, safety belts, seat belts. He created that. But he went under because lobbyists. He got squeezed out of the industry.
It happened. It happens to a lot of people.
Yeah.
You look at the paper industry, the paper and plastic industry. When what's the whole? They're yelling about go green nowadays, right? Well, back in the 60s and 70s, people figured out that hemp, which hemp is a byproduct of marijuana, could create better paper. So like if you had a newspaper from 1970 and it was hemp paper, it would never yellow and it would never deteriorate. Hemp is biodegradable, and there was hemp plastic. Hemp rope is stronger than regular rope. So all these industries got together, they started lobbying this, and then they came up with the term devil's lettuce and this, that, and the other thing, and they got it outlawed.
Yeah.
And now we're yelling about going green.
Yeah.
And we could have gone green how long ago?
Could have gone green in the 60s.
Right. It's crazy. Or not Tesla the car, but Tesla the scientist. He created there's a theory out there, and this might be a little conspiracy theory, but there's a lot of papers on it, that he might have been murdered because he created sustainable energy that would be basically free for the entire world.
Yep. It just was time because you had so many greedy owners who were different, who had the status quo of that supply source. So
and that all, and it also goes back to why is there a shortage, right? There's a shortage in real estate because they disincentivized builders post 2008 to build spec homes and to build bigger communities. So they disincentivized it. So there was more profit now to build custom built homes. So a lot of builders either went out or got out of the industry, and then there's not an incentive for them to build these massive neighborhoods anymore. And it's a lot harder to get workers and things of that nature. And the more, we've caused a lot of our own inflation. The Fed's tied to it, big time tied to it. And this is going back into the Trump administration. I've been screaming since 2000 and probably 16, 17. We need to raise interest rates. Money is too cheap. And when money is too cheap, meaning you can borrow money at a low rate, it's going to cause inflation to go up. And then they shut down the supply chains. They shut down the entire country. Every country in the world kind of shut down. We don't make anything at home, so our supply chains get backed up for 2 years, caused inflation to go up, and that was because of COVID. And then when we open back up, by the way, they printed a bunch of money and sent it to the Americans because, hey, you can't work, so here's a bunch of money. And what they do with it, they paid off a lot of their debt, and they spend a lot of money. Which
they bought TVs is what they did.
Right.
They went out and they spent it all and went on vacations. They didn't pay any debt off, and they didn't invest in any properties either.
Right. Well, and what would happen is they would go out, and so they're spending money, and so money's flying around, and we're spending money like drunk sailors, and we're thinking, okay, well, this is going to be a good thing. No, that drove inflation even more. And my favorite part is Trump signed his name on the first check, and it was a great thing.
Oh, yeah.
I disagree. It's never a great thing to print money. It's just so funny to me that he signed his name on it. Hey, reelect me. I sent you this check. So but anybody who him especially, who's a capitalist and has all these buildings, you should understand that shutting down the economy and then printing money is probably a terrible idea, especially since if the economy is shut down and we don't make anything here and the other world economies are shut down that we have zero control over, how are we going to get any of the goods we need? Like medicines, all made in China. Like we couldn't get anything. So the price of everything skyrocketed because there was a high demand, low supply. Yeah. The same thing happened with the lumber. And the other piece to that is, is West Coast, there's a lot of forest fires. So my business partner actually has family in the lumber industry, like very high up in the lumber industry. We could not get anyone to come on our podcast to talk about the lumber shortage because they didn't want to be blamed for the inflation and the appreciation of homes. But long story short, the Fed kept the interest rates too low for too long. And then when things started to open back up and, inflation was through the roof, they started hiking interest rates too slowly at first. Just rip the Band-Aid off. Just pull the Band-Aid off. If you're going to have a controlled economy, which you're trying to do, and you're doing a terrible job of it, but what you're trying to do, then just rip the Band-Aid off and spike the interest rates 1% off the rip. They didn't do that. They go quarter point, 50 bips, 50 bips, and then, oh shit, this isn't working, 75 bips, but they never allowed time to see if it works. It takes 6 months to see the adjustment. And then you start looking at the indicators. We should have stopped hiking interest rates last October because it takes a 6 month adjustment. And anyone who understands consumer pricing index CPI, which tracks inflation, understands that those are 12-month rolling averages.
So how do you explain what Rome is doing with the Federal Reserve? How do you explain that?
What, who's doing?
Mr. Powell, I'm sorry. Jerome.
Jerome Powell. How do I don't know if there is an explanation. That was another topic of our podcast recently. Like, how do you get a job with the Federal Reserve? And it's all of them. It's not just him. It's like Janet Yellen, who used to be there. It's the Minneapolis Fed chair. It's the Atlanta Fed chair. It's all of them. Like, they don't understand simple concepts. And what it is they're reactive and they're not proactive. Yeah. Right. So if you're proactive, you look, even if you wanted to hike in October, November, just to be safe, that probably won't push us over the edge. But then you look and you say, okay, housing numbers. What's the 43% of that CPI report is coming from the cause of inflation? 43% of it was the rise in rent prices. And it was massive, like 15 and 20% year over year. Well, guess what? It's only gone up 2.6 year over year. When are most leases signed? August, which we've already been through those, and then January, February, March. Those leases are lagging. So that report's going to come out on May 10th. And then I believe that we'll start to see interest rates fall. But the problem with that is we have an inventory shortage. So interest rates fall, demand goes up, mass appreciation is going to happen. So first-time home buyers, when interest rates come down, you're going to see the cost of housing go up. So one of the things we do here is we date the rate, we marry the home, buy the home, we'll refinance you. But interest rates, when they come down, it's going to be almost impossible to get into homes. And we're already seeing it. 20 offers on a $350,000 townhome. Like, but how do I explain what Powell's doing? I don't understand how he got that job. I don't understand how any of the Fed got that job. Just because you went to an Ivy League school, it doesn't make you smart, and they don't seem very smart. I don't understand how somebody like Janet Yellen can sit here and say, we're going to pick and lose winners if there's a bank run. And she didn't say that exact word. Basically, she said she's going to pick who to bail out, and that the Fed's going to pick who to bail out based on the economic impact it would have on the country. So if you're at South State Bank down here in the Southeast, that's not big enough to get bailed out. So if there's a bank run, good luck. Yeah. Good luck. Janet Yellen doesn't like you.
I guess it's leading into this whole thing that's going on with China brokering the peace negotiations with the Saudis and the Iranians.
Oh, and BRICS. Yeah, that's going to work out well.
You know, this whole thing about the decline of the U.S. dollar because of the strengthening of BRICS. And
it's not the strengthening of BRICS that's causing it, though. The reason that BRICS is strengthening is because Russia, when the Russian-Ukraine war started, and what you feel about Russia-Ukraine, I don't care about that. I care about America and our survival.
I got my own personal ideas about that, which are not popular, but anyway.
Well, I think I would almost disagree with you. It probably is popular. The news just doesn't say it's popular. If you talk to most Americans, we probably are on the same page as we need to mind our own business. So what we did was, and I try not, that's not political, that's common sense. My parents used to say,
yeah.
my parents used to preach, it's none of your business. Stay out of it.
Yeah.
It's none of your business. How the hell are they preaching that to me? But the country as a whole, we don't stay out of it. But however you feel about Russia, Ukraine, here's what happened. Russia and the entire world had reserve currency, which was the United States dollar. And we'll call it the petrodollar because Nixon decided to pull the gold standard.
In 1973, yeah.
And for all the reasons they gave, that wasn't the real reason. So you need to look into the actual writings and documents that came out, because every 7 years there's document dumps.
Mm-hmm.
Anyways, long story short, no longer on the gold standard. All oil is traded in U.S. dollars. All reserve currencies around the world was U.S. dollars because it was the most stable because of capitalism. And it was the most stable because nobody manipulated the currency like the CCP does with their currency, which Chinese Communist Party. But what our administration decided to do, because we wanted to quote unquote police the world, which I think is bullshit. There has to be more reasons to this, is they decided to go and take the US dollar that was owned by Russia as their reserve currency, and they pulled it from them. So they pulled US dollars that were owned by a different country and said, those are no longer yours. We're taking them back. So you now just used, and then they went on TV and bragged about it. And I'm sitting here, it's like, how stupid is that?
Mm-hmm.
That's like parents using a child against each other.
Yeah.
Like, that's a terrible idea. It never works out for anybody, especially the child. So now you're going to take, in this instance, the child, the US dollar that is owned by another country, and you're going to pull the US dollar and use it as a weapon against that country because big bad Russia. Well, Russia hasn't been big and bad since the Cold War. So why are we still talking about them?
Yeah.
One. Number two, you just showed the rest of the world, who hates us, by the way, because we still are the greatest country in the world. You just showed the rest of the world that you're willing to pull the US dollar whenever you just disagree with something that they're doing. So why would they use the US dollar as reserve currency anymore? So the reason that the BRICS nations, which is Brazil, Russia, India, China,
North Korea's in it, eh?
South Africa, yeah.
South Africa, they're now saying, okay, world, did you see this? Did you see what the United States just did? Mm-hmm. They used that currency that is supposed to be the backing for everything in the entire world as a weapon against one of their enemies, so we can no longer trust that currency. It's one of the worst political moves I've ever seen. It's one of the worst financial moves I've ever seen. Mm-hmm. So how do we fix that? I mean, I don't know, but I do know that 19 nations just applied for BRICS. Yeah. Now, we still control
Was Mexico one of them?
Huh?
Was Mexico one of them?
Mexico, Canada,
that ain't good.
Saudi Arabia.
They're our border buddies, but that's a whole nother problem there, where the U.S. has always tried to put Mexico in check. You know.
Well, the problem with this is like there was an opportunity to really help build up Mexico, and instead of doing that, we chose Canada as the winner. Yeah. And look at what's happened in Mexico now. We killed industry there. You should, like I talked about earlier, picking up communities through the down payment assistance program, financial literacy. Let's pick up our communities. Well, the United States community is Canada and it is Mexico.
Exactly.
So why aren't we picking our communities up? Why? And the other piece to it is, and I don't want to get too political here, and most of this stuff is just common sense, but like, even like border control, Mexico doesn't want a bunch of people from other countries running through Mexico to come into America because we can't control our own borders. Like, there's a million things that I just question. But really, when it comes back to like the housing industry, inflation, interest rates should start dropping. The one thing that would scare me though is the U.S. dollar. Now we still have 76% of the world currency reserves, 76% of the world reserves. Mm-hmm. But that number has fallen. And if we keep printing money, and there's a big thing, and I'm glad that the House, the government split right now, half Republicans, half Democrats that have been elected, because it's kind of forcing them to freeze. And it's a good thing, I think, that the Republicans are in control. I think it's of the House right now, and won't vote to pass the budget. Mm-hmm. Because the budget is talking about going up to $50 trillion in debt. So to educate people a little bit on that, how can we just keep printing money? Well, the way you keep printing money and make it okay to print money, which I don't think it is. I think we need a balance, and we haven't been balanced since Clinton.
Yep, when he put that zero on that easel.
Right. So the gross domestic product, the GDP, what we create here, has to keep increasing enough to cover just the interest payments on the debt, right? So if we go to 50 trillion and we're in a recession, which is not a shrinking of the economy, it's a slowing of the economy, our GDP is not going to increase at a significant rate that it needs to keep up with the interest payments on those debts.
Correct.
So I think it's a good thing that they aren't passing the budget at this point, because that would have a big effect on housing. Now, I don't worry about those things. I don't want the first-time home buyers to worry about those things. Getting your home, we'll take care of it as we go type of thing, and worry about what you can control. But at the end of the day, we need new government officials. We need Congress and Senate and all that good stuff. They need term limits. Like, there's a lot that we need. I just signed a petition for term limits the other day. We need more than two. We need more than two parties. There's a lot that we need. But yeah, we the reserve currency we talked about on the last podcast, because it affects all industries. It affects the United States. Oh, here's the other thing. You want to get a little bit nervous? Look up the last time we did an audit on our gold reserves. It's 30, 40 years.
Yeah.
So if the dollar does collapse, what do we do?
Yeah.
Oh boy.
And it may be part of the plan to crash the dollar. When you say 76% in reserves, you talking about oil, natural reserves in the United States?
Can you repeat that? It cut out on me for a second.
Yeah, when you said 76% in reserves.
Yeah, so 76% of the countries in the world still use the dollar as a reserve currency.
Okay. Of the world using 70%.
Yeah, and that was a number from a few weeks back. Now, all these countries, here's the other piece. I don't think the U.S. dollar is going to not be the reserve currency. It's going to be a slow fall if it is.
Oh.
I think you get the right people in the office, they're going to be able to fix the situation. As much as people hate Trump, this doesn't happen under Trump. And it wouldn't have happened under Obama, and it wouldn't have happened under George Bush. It just wouldn't have. This is the worst president we've had in the history of the United States. Because he's not there. You have to lead from a position of strength, and there's no strength there. So it doesn't matter who the president was in the past. Up until this point, I don't think this would have happened. But here's the other piece. It would be a slow fall, and I think people are about to find out the hard way that you can't trust China.
Yeah.
So go ahead, use the yuan or whatever you want to use to trade for your oil and as your reserve currency.
Right.
Wait, and if you think the U.S. dollar is bad and what they did was bad by using it as a weapon.
Years back, I come from the restaurant business, Nick, and years back, when there was a shrimp shortage in China, and they came and they bought all the shrimp in the Gulf, and we couldn't provide shrimp. And I said, where is our protection as Americans with respect to other people, right? But where's our? This is where I'm a capitalist, but this is where I get upset with capitalism. Where is our protection? Because we're allowing a business to come over to buy our product, and we can't feed our own people.
So I believe in capitalism, but I do believe you have to have a mixed economy. And what I say by that is we need to help people, right? But we have
I have no problem with the social help.
Right.
That.
So speaking to your point of being able to sell the shrimp, why don't we incentivize our companies instead of incentivizing them to move everything to China? Because that's what we did, and that's why that happened. And that was back during that was a lot during the Clinton administration that happened. Why wouldn't we incentivize Americans be taken care of first, and then if we can help, we can help, right?
Yeah.
Why are Americans
the airplane oxygen supply bag? Take
Right.
care of yourself first, and
because
then
if you don't take care of yourself,
you got to put the oxygen on first, but then put the neighbor.
Right.
Yeah, that's a good idea. Hey, that's good, James. I like that.
So that is that's incentivized. That was because of the incentives passed during the Clinton administration that incentivized businesses to do business with China first and not Americans first. Like, America first should be the thing, because if we can build our ideals, our morals, our country back up to what it was even 35 years ago, we lead from a position of strength, and we lead from a position of the moral high ground. But that's a political discussion where we have to start voting for the right people, and I don't know if we're going to do that because a lot of people they don't.
Yeah.
I mean, and who's the right people when there's two parties?
And
Exactly.
who's here's the thing, and who's the right people when there's lobbyists? And I'll tell you why there's a
Right.
two-party system, because we have three branches of government. We have two houses. If it was one house, you could have multiple parties. There's
Right.
two houses. So if you have a third party all in Congress, who's in the Senate?
Hmm.
You see, if it was a one house system, you could do that. But we have two houses. So that's why the two parties are dominant. I agree we should have three parties, but it's hard as
I
hell
think it
to
should
get a
be
third
4.
party.
Yeah.
Yeah, it's hard as hell to get another person in there
It is.
because of the system.
It is. You're right. You're right. It is hard. There's things we can do like term limits and such that would change that, though.
I'm all for term limits.
Yes, absolutely. Guys, I'd love to continue this conversation. We are short on time. I've got to get to a closing. I want to say thank you, Nick.
Evelyn, we went off track. I'm sorry.
It's fine. It's fine. Hey, that's a lot of information, sir. That's why I wanted you on the podcast so you could talk. Yeah.
Oh man, that's my specialty.
Nick, you have contributed tremendously well here. Thank you so much for being on our podcast.
You guys got to come on ours. Come down and visit. We do everything in person, so I would love to get you guys on.
Awesome.
Great. Fantastic.
Well, thank you so much again.
Nick.
What'd you say?
What's your contact information?
Yeah, my phone number is 980-263-7274. But really, if you want a mortgage or a down payment assistance or you want to discuss that, call Evelyn. Evelyn, give them your phone number because Evelyn's your go-to girl.
Mm-hmm. Yeah, they have my phone number. They have it already.
Well, tell anybody who might be watching.
Mm-hmm. Yes, so my number, Evelyn Olivars with NBI Financial Group. My number is 336-912-0332.
Awesome. And then go follow us on NBI Financial Group LLC on all of our pages, YouTube, Instagram, Facebook, TikTok. We try to provide value, education, and understanding. And that's why we talk so much about the down payment assistance and the conversation that we got into. A lot of our understanding of the mortgage industry, like it's not just mortgage and real estate. You have to understand big picture to understand what's going on in small picture, which is why it's still a great time to buy because you're going to gain mass appreciation as soon as those, interest rates drop. And then, we'll get you into a lower payment as well. So, but thank you guys for having me. It was a pleasure.
Thanks, Nick. I know you had a meeting too, so I appreciate you being on here.
Oh yeah, absolutely. This stuff's important. And, I think my passion is educating people and, not spreading rumors, but everything I told you from the appreciation gained over 3 years, that's all core logic data. Like you can't argue data. So,
absolutely.
All right.
Well, thank you, Nick, so much. James, Evelyn, thank you. I'll see you guys next time.
Bye.
Bye.
Bye. That was great, guys.
Are we still on the show or it says everyone?
Well,